Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest, and his name is Ryan Weimer. He is at Boise, Idaho, and today he is going to be teaching us what is creative finance and why creative finance in real estate is the biggest opportunity. He's going to be teaching us about owner financing. He's going to be teaching us how to take over people's loans and also a hybrid strategy. Welcome to the show, Ryan. How are you?
I'm doing great. Thanks for having me. Excited to bring the listeners some knowledge and some stuff to implement right away.
Yeah, it's funny because somebody asked me, they're like, "Well, what makes a good real estate investor last over a long time, or what makes a really good real estate agent last for a really long time?" And I think it's adaptability, meaning being able to adapt to the current conditions of the marketplace. And this is kind of the direction that I'm seeing a lot of the investors adapt with interest rates being high. They're just doing more creative type of deals. So, Ryan, for our viewers that don't know who you are, who is Ryan Weimer, and then how did you get involved in this world of real estate investing?
Sure. So my background's in mechanical engineering,
Mhm.
and really, just long story short, the corporate route wasn't it for me. I wasn't fulfilled. I wasn't making a progress towards early retirement like I thought I would be able to if I just climbed the corporate ladder. So somewhere in there, I found bigger pockets, and that got me into real estate. And really, it just started with, all right, how many rental properties do I need, and how much cash flow do I need to replace my income so I
Mhm.
can quit my job? That was really like stage one. I was living in San Diego at the time, and I definitely couldn't afford anything there. So one of my roommates was born and raised in the Boise market from college. And I said, hey, let me check this out. It was still pretty cheap, and still is relative to like a lot of your Denver West markets. But we took a trip out there. We bought a single family property, split it 50-50, still own that thing. And the rest, it just really catapulted from there in momentum. And we started doing direct to seller marketing and doing more and more deals. And then we just started doing, rentals, fix and flip, wholesale, some ground up construction, Airbnbs, really the whole thing. But it all started with finding the deal, right? And becoming a master of deal finding.
I love it. I love it. Good. So for our viewers that don't know what creative finance is, what is creative finance? What are different ways to structure deals? And why is it important in today's marketplace?
Sure. So when we say the words creative finance, it's really just a fancy term for not cash and not conventional. So we're not cashing out the seller in full on the sale. So we are being creative in the terms that we adjust to match both our needs as the buyer or the investor and the seller's needs. And then I guess part two of the question was,
Yeah, part two of it was just what are some different methods for creative finance and then why it's important today.
well, it's important today because interest rates have doubled in 8 months in 2022, which has never happened in history before. Cost of capital is up. There's a lot of fear around recession. New listings, new sales, and inventory are all near all-time lows or at all-time lows right now. So there's kind of this standoff going on in the marketplace. If you're a realtor, if you're in the mortgage business, if you're a fix and flipper, and now if you're in the commercial multifamily space or commercial office space, really commercial space in general, the cost of capital has increased so much that there's a lot of people hurting out there. And when we talk about creative finance, we're referring to either a seller finance or a subject to type of transaction, or you can combine them into what we call a hybrid. So we're really just figuring out ways, instead of a cash sale or getting bank financing or private financing, to be able to own an asset without that high cost of capital. And in this environment, this is the perfect time to do it. 7 out of every 10 mortgages right now are at or below 4%, and almost 3 out of every 10 mortgages are at or below 3%. So when we think about where interest rates are at in the environment today, 6, 7, 7.5%. This is why I say this is the biggest wealth building opportunity that nobody is talking about. It's being a creative deal maker to take over this low long-term fixed debt that you can't get anymore. And this isn't just a short-term thing that's going away next year. These are notes that people have on their property that are going to be good for the next 28, 29 years. So this is a tool in your tool belt you definitely need to have, or else you're missing a
Missing
lot of
out.
money and a lot of wealth.
I love it. What I was going to ask you is, what is the main difference between owner financing and a subject to transaction?
Just to keep it simple, it's do they own the property free and clear? That's going to be a seller finance, or do they owe a mortgage or some kind of note and have some kind of payment on the property that's going to be a subject to? So that's the big difference.
Got it. And then whenever you combine both of those strategies, how does that work?
If we combine both strategies, let's say somebody has a mortgage on a property, we take over those payments of that note. And then instead of paying the buyer out whatever that difference is between the purchase price and what the note is, we finance that equity to the seller. So let's say somebody owes $75,000 on a $100,000 property. So they have $25,000 in equity. We take over that $75,000 note, and then we take over, we make payments to that seller in a note for his $25,000 of equity. So we have a payment to the first position note, and then we have a payment to the seller's 25K over time.
I love it.
Yeah.
How do you figure out like which sellers are open to this? Like, what does that look like?
Yeah, so typically your seller finances are going to be a lot of tired landlords. I guess the most common people to do a seller finance are going to be that like mom and pop landlord that they've owned the property for a long time, and now maybe they're getting older. Maybe it was worth it when prices were going up, 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 up. Everything was going crazy. And now all of a sudden in a new capital environment, the asset value is going down or plateauing depending on your market. And they're like, I just want mailbox money. I don't want to deal with the hassle of collecting rent anymore and dealing with these tenants. So they can finance the property. There's no bank or anything that's needed. Instead of us just going to a Wells Fargo or a Chase or something like that, we just go to the seller and say, hey, well, what if I could come up to your price and just make payments to you over time? And, is that something that you could work with us on? And that starts the dialogue. Also, mobile home parks or mobile home owners with land in general, just because those are going to be the types of people that have trouble getting conventional financing anyways. If you're not on a foundation, or just if the mobile home or mobile home park is of a certain age, a lot of institution or lenders aren't going to be able to touch that. So those owners are a lot more receptive to either seller financing or creative financing strategies. And then ironically too, like the bigger the deal size, the more sophisticated the owner is, the more open they are to this kind of stuff, which makes it great going after bigger deals because they actually understand the lingo and they know the lay of the land. It's not like most of your single family owners that have never heard about this before. So ironically, the bigger the deal, the better this works.
What would that conversation look like? Like, so like, let's say that I'm a seller, you're obviously an investor. I am a tired landlord. I think I want my cash out of the property. What would that like look like? So, yeah, I'm interested in selling. My price is $1 million for the property.
Yeah. Yeah. So I'm going to ask you, first of all, what's the reason for selling? And we have a full sales script and talk track that we teach our team, because right now our whole team is doing creative finance and it's a bit tricky to train on it, but it's all going to come down to the wants and needs of that seller, right? If they're looking to do a 1031 or upsize or buy into a different property, then this isn't going to be the strategy for them because they need all that cash or they have a use for all that cash. But if they're looking to maximize the amount of money that they make over time, this is going to be the option that they want. So really, if you're saying, hey, I want $1 million, I'm going to say, oh, Okay, great. $1 million. Can I ask, what are you doing with the proceeds? What are you doing with the funds?
Probably just putting it in the bank account. To be honest, I'm just tired of managing this property. I'm just done. I mean, I've been managing properties for 30 years. I'm 75 years old. I don't have the time, energy, or resources. None of my kids want to take over the property. So I just kind of want to simplify.
Gotcha. Okay. And then I'm going to ask you, hey, well, if you sold this cash and the money's going in the bank, I mean, gosh, what would your tax liability be if you sold it? Because it's a non-owner occupied property, so you've held it for a long time. I'm sure you've got quite a big capital gains tax bill on that thing.
Yeah, I'd probably say like I bought it for 100. I'm selling it at 1 million, so I've got like 900,000 in gains at least. So 20%, probably looking at close to 200,000 in taxes that I probably be paying at that time.
Wow. Yeah, I mean, gosh, if there was a way for us to limit that tax burden or spread it out over multiple years so you don't take that 200K hit all at once, I mean, is that something that would even work for you or you'd be interested in hearing about?
It would depend. Like, what do you mean by that?
Sure. So, like, instead of just us going to a Wells Fargo or a Chase, or using some of our private lenders to buy you out in cash, you just become the bank. So you'd be converted from a landlord to a lender, and we just make payments to you over time instead of to the bank.
Got it. Okay. Yeah, I may be open to that. Like, I would just want to make sure that I'm protected. If I am open to that, I would
Yeah.
probably want a good down payment. And then what type of interest rate would you guys have in mind?
Sure. So the best thing about creative finance and seller finance in general is all this is negotiable, right? So if we could come up to your price, would you be able to work with us on like the monthly payment and the down payment and stuff like that?
Yeah, yeah, I would. I would be open
Okay.
to working with you guys. As long as I can get like I think I would want something similar to whatever I'm collecting in rent. If I can get that amount of payment, I think I would be open to something like that.
Okay. Perfect. Well, typically as investors, right? I mean, for us to be able to get our necessary return and be able to make a profit, it behooves us to have the lowest down payment possible. And obviously, for you, we want to make sure that you feel good about your security on the property and making sure you get what makes you feel comfortable in terms of a down payment. And we can probably work something out and work out those details. So, could you tell me, I guess, if you had to rank price, monthly payment, and down payment, um, which of those would be most important to you?
I'd probably say the price would probably be the most important, followed
Okay.
by down payment. Like I don't really need the money, but I just want to make sure like that you guys don't walk away from the property or that you guys just start collecting rent. Then it takes me like a whole year to foreclose on the unit.
Totally. Totally. So, yeah, I mean, in all the properties that we seller finance, because we've been in your shoes too, and we seller finance a few of our properties to other investors, we make sure that there's a deed of trust secured against the property by the title company. And actually, the best thing that could happen to you is that you get the property back plus get to keep our down payment. Now, we've never been foreclosed on or had to foreclose ourselves, but it's nice to know that you have that option because then in that scenario, you'd get to keep the down payment that we gave you and you get the property back. So that's like hitting the jackpot.
Yeah. Would you guys be able to do like a $500,000 down just to I mean have enough like 500,000 that would mean I would carry the other 500,000, or is that too high?
Yeah, I mean, typically that's higher than what we could get at a bank. So usually we don't go that high. However, it really depends, right? Like you mentioned earlier, the interest rate. So depending on how high of importance that is to you, if you want something closer to market rate, or if we can get something sub market rate that makes it more advantageous for us. You see where I'm going with this is like I can pull any lever you want here and we can meet in the middle on these things. So I can come up to your price, I can come up to your down payment. I just need to have some things in return. on like interest rate and other variables. And that's the talk track that will continue down until we really discover like what's most important to them. And I'll use a lot of, well, what if, I could convince my underwriter to do that 500K down? I mean, I'm not sure if we'd be able to hit that $1 million price, but maybe if we did like principal only payments, or if we did a smaller interest rate, that might work for you.
Yeah. And then on your end, like, how are you determining whether a deal makes sense for you guys or not? Like, what do you guys look for? Like, if you guys are looking to do owner financing.
Yeah, I would say it's always our preferred method of acquisition. Like, even if there's equity in the property, we're always looking to see if we can do a creative deal. A reason is opportunity cost of our own cash and capital. Like, if we're needing to use private money or our own cash or another bank to finance all these deals, we run out of money quick. So even if we get some terms that maybe aren't ideal forever, you get a property under seller finance or creative finance, the honey is in that length of duration. And so a
Mhm.
lot of times the biggest objection we get is the sellers want a balloon payment in 3 to 5 years or whatever. And that's not really us getting the full advantage of the terms. So usually to overcome an objection like that, we just say, hey, look, in order to come up to your price, we would just need our terms. And with 3 to 5 years, it's just not long enough time for us to take advantage of those terms. So there'd have to be a concession in price.
Got it. Now, what if I say I may not be around in, like, I know you want like 7, 10, 15, 20 years. I may not be around after 5 years. So, like, what would you say to something like that?
Well, I would just say maybe cashing out is the best option for you, or maybe we can spread those payments out over. I mean, how much longer? I know this is kind of a morbid question, but how much longer are you going to be around? You think?
I don't know, to be honest. Like, let's say I'm 80 years old, like 5 years I'll be 85, 10 years I'll be 90, 20 years I'll be 100, you know? So I
Sure.
I don't know if I'll be around at 100, but and the reason I'm saying this is I hear this sometimes where they're like, "Hey, look, like I may not be around for that time."
Yeah. Yeah. So my question would again be, well, in a hypothetical scenario where you get cashed out, I mean, are you going to buy something with the funds, or is it going in a trust, or are you going to pass it down to your kin? Because these notes also would transfer to your kin as long as you have it written up in your will and trust correctly, and we do all the paperwork properly. And that's a way for your kin to get those monthly payments and make some interest as well. Or if you really do have a use for the funds right now, then I can understand how, hey, this might not be a viable solution for you.
Got it. I love it. Cool. Yeah,
Yeah.
and I think I heard in a podcast, it was like, "Oh, well, look, the best thing that could happen is that your kids take over, or this gets transferred to your kid, because now what you're doing is, like, let's say your kids aren't as good of a money manager as you are, and you give them a lump sum of $300,000, they may go out and spend it, versus if you give them an equity, or not an equity, a stream of income for the next 30 years. Now they've got $5,000 every single month coming in like clockwork, and that might be actually better for them than to leave them a property where they have to manage it, they have to fix the toilets, or you leave them a large sum of money, they may not know what to do with it. So it could actually benefit them. How do you determine, like, whether or not there's actually a tax savings for them? Like, do you have like an accountant that you recommend them to? Is there like an online calculator that you guys use? Is there like a spreadsheet? Because I've always wondered, like, I know that there's tax savings, but how do you run like an actual scenario for a seller? Like, hey, you purchased it at 100, you're selling it at 900, you've been depreciating it for the last 20 years. This is approximately what it would look like if you cashed out on it. And this is what it would look like over time if you basically financed. And do you also, like, if they're selling it at a million, but they're doing seller financing, once you factor in the interest rate and everything, they're actually collecting at the end of it 1.5, 1.7 potentially, or 1.3, just depending on the interest rate collected. Do you guys show that to them as well too, or how does that work?
Yeah. So to answer your first question on the CPA thing, we know when we're structuring a deal like this, especially if it's a tired landlord, we're gonna get that objection. And so for us, we wanna handle that objection in the beginning instead of agree on all the numbers, all the terms, go on multiple appointments, put pen to paper, and then have him say, well, before I sign this final line, I need to run this past my CPA. So we get ahead of that early in the conversation because the truth is that's really going to depend on someone's personal tax bracket, right? Like how much have they sold other properties in that year? Are they still working a W-2 job? Do they have social security income? Like there's so many individual factors that would make it. So we give someone early in the process, hey, um, so if this sounds like, I mean, would this even work for you? Does this sound like this would even be an option for you if you can make way more money over time? If yes, please go talk to your CPA about this and see what your tax liability would be if you sold at this number in cash. And then let's talk again next Tuesday and you can tell me what he said, or I can get on a three-way call with your CPA and you, and we can flesh that out early in the process. So we want to take care of that objection early. And then, yes, to answer your question, we do want to show them there's a couple online calculators that I can actually share with you and share with the audience that we show the sellers of like, man, I know you said you wanted $1 million cash, but if you sold it on terms, look at how much more money you would make over time. And that's a really powerful thing when they can be like, oh, dang, I'm going to make 700K in interest over the course of this thing. That's like almost a 2-for-1.
Yeah, especially if they don't have anywhere to put their money. Like it's almost like, yeah, they can take it to the bank and maybe earn 4% right now, or they can do something a little more creatively where they still have the income stream and potentially save money on taxes. Do you know the names of those calculators by any chance? Or is that something that maybe you could send to me after and I could link it in the bio?
Yes, I'll send you those. There's a few that we use. We use an amortization schedule and then a couple other calculators, but I can send them to you so you can link in the show notes.
I love it. I love it. Cool, man. And what about the subject to deals? Who's the demographic for that, or who's like your typical seller for that?
Yeah, so there haven't been a lot of these lately, but it's going to be foreclosures. People that have bought like in the last couple years that might have little to no equity, but they have a really killer interest rate. So anyone that's in a foreclosure situation where they don't have enough equity, if they listed it on the market, or even if they sold it for cash, they might be in a situation where they have to bring money to close or walk with zero. Those are prime for subject to because they really don't have any other option other than to lose the home. If you've got sellers with financial pain too, like if you've got people that have maybe they have a little bit of equity, but they've also got some credit card debt. They've also got payments here, payments there. Maybe they got a lien to get on the property. Like you can sub to pretty much anything. You can sub to medical liens. You could sub to solar panel liens, mechanics liens, home equity lines of credit. Like it doesn't just need to be a Wells Fargo 30-year mortgage. So there's a lot of options for people that have financial pain that they don't even really know about because they're not in the creative deal space. Analytical type sellers that are really stuck on a number, like in our exercise earlier, when you're like, I want $1 million, especially with the roller coaster of what has happened in the last couple of years with the market and interest rates. There are people that didn't sell in that window in 2021, early 2022, before things started changing, or maybe they listed last summer. They thought they were going to get a certain price, and now they're so emotionally wrapped up in that price. You'd be surprised how many people are just like, nope, I want that $1 million on the purchase price, and I don't care how I get it. And that's an example of where we do we take over the first position payments and then we pay them their equity over time as well. And even if it's a very low, like there's a deal that I did where I'm paying the guy $100 a month at 0% interest for his 250K of equity for the next 230 years because he was just stuck on a number. He didn't care how he got it. And there's a lot of people like that. And then failed listings too. So if you have this in your tool belt, you're going to have to do a little bit of educating because a lot of realtors and a lot of investors, it's getting a little bit better now in a high interest rate environment, but a lot of people don't even know that you can sub to a property or that it's even legal. And again, that's getting better, but failed listings, a lot of these, even if you tried to make an offer on the market, sometimes realtors just won't even present it to their clients. They'll just shoot it down right away. Like, no, they want to cash out and that's it. And they won't take anything else. Well, it starts a
Yeah.
conversation there about how bad do they really want to sell, right? So,
You mind if I hear the story about the $100 for 230 years? And then maybe even like if you can kind of give us a couple different stories as to like some creative deals that like, because when I hear $100 for 230 years, I think like, why would this, like, who would do such a deal? So I love to hear that story if possible.
so it was a guy who, divorce situation, they divorced like 10 years ago. And I guess she kept the property and has been living in the property ever since. And it's been part of their divorce agreement that she gets to stay in the property rent free. And so, but it's still in his name. And I guess this has just been a thorn in his side for many, many years to the point where now he was just like, I want to get rid of it, but I don't want to feel like I'm getting ripped off. And I don't want to deal with these other cash investors. I hate realtors. I don't want to pay any realtor fees or commissions. I just want my price and I want to be out from under this payment because he had a first position note on it. So I just went to him and I said, well, I mean, if I could come up all the way to your price, could you work with us on the terms? And he said yes. And I said, so what are we talking here? What would this look like? The property needs some work, and that's usually the leverage that we use to get the down payment lower. So in this example, he's like, well, I want, 50K down. I want a 365K purchase price. And I said, well, hey, we're going to need some of that down payment to address the repairs in the property and get it rent ready. So after all those repairs, man, I can come up as far as I can, but in order to get you to that price, which you said is most important to you, I think we'd need to be in that 8 to 10K range down. And he just said, okay, well, that sounds a lot lower than what I wanted, but you're right. Gosh, it needs all this stuff. It needs all this work. And you guys can still come up to my price. What would that look like for my payments? And I said, well, what if we just did $100 a month? I mean, your first position note is already $1,300 a month. So if we went to like $500 or $600 a month for you, then we wouldn't be able to cash flow on it as a rental because we're going to put a renter in here. We wouldn't be able to cash flow positive. So that really wouldn't work for us. We could come down lower on that purchase price, but it sounds like that's the most important thing to you. And he said, yeah, you're right. I mean, I just really want this price. This is the number one important thing. So if that's where you guys need to be, then I'm agreeable to that. And this is what I always coach my team and my students too is we never bring up interest rate and we never bring up number of years unless the seller brings it up. Okay. So those are two big no-nos. If you're pitching this is you never bring up interest rate and you never bring up number of years because to most sellers, it doesn't matter. And if it does matter, they'll bring it up in conversation. As investors, we care about that interest rate and we care about the number of years and we care about down payment. So just that's some quick tips too when you guys are negotiating this stuff.
So what's the best way to negotiate these types of deals? Because I'm an elementary student as it relates to creative financing and maybe even in investing as well too, relative to some of the other guys in the collective genius space. Like how do you negotiate a seller financing deal without talking about the interest rate?
So the way that we write it up is if someone really what our talk track is price and then monthly payment. Like those are the two things that we really focus on the seller because those are typically what a seller really cares about. And if not, then they'll correct you, right? And they'll tell you, no, actually, I want this. But the way that we write it up is, hey, if we can come to your price, what kind of monthly payment are you looking at? And then the down payment is really the thing that we negotiate hardest, because we want to be in the deal for as little capital as possible. So the way that we write it up in the contract is once we agree on that monthly payment and that down payment amount, then we'll just write it up. Seller will pay so and so $500 a month on their second position note and take over the first position payment in principal only payments. We will write that up, and as long as we're hitting their price, they don't care. Now, if they tell us in the conversation that they care, then now all of a sudden it becomes one of the levers. Okay, well, hey, if we come up to interest rate at 5 or 6%, then we need some flexibility on getting that down payment lower or getting the overall price lower, getting the number of years longer. Like, it's really all just if I give you some here, then I need something over here. And typically these kind of conversations are just going to take more time than your average seller, right? It's going to take more touches, more conversations with your team to negotiate these and make people feel comfortable, because it is a little bit more complex. And when you're asking the right questions, you really do discover, well, they said they cared about monthly payment, but they really care about interest rate more than that. And then you can get really complex where well, I can do a 5K kicker every single year for the first like 3 years. If my cost into the deal year one, my down payment's only 10K. Like, you can do step up interest rates. That's one thing that Eddie Speed's really big on, is stepped up
Yeah.
interest rates, which means like, okay, years 1 through 5, 0% interest, years 5 through 10, 3% interest, years 10 plus 6% interest. And a lot of sellers will go for that because they feel like they're still getting that 6% interest in
6%.
the end. Yeah.
And the benefit of that, just for our viewers to recognize, is that if you're paying 0% interest on a higher loan balance, your principal is going down really fast. And then the next 5 years, your principal is going down. So yes, you are paying 6%, but on a much lower loan amount. Because I took Eddie Speed's class as well too, and when he explained that to me, I was just like, "Oh my God, this is brilliant!" Like, I had never seen anything like that. What I was going to ask you, in that scenario where you're not even bringing up the interest rate, you're basically negotiating a 0% interest, basically, without ever bringing it up. It's almost like, okay, what would you want your monthly payment to be? Let's say it's 5,000, and then, okay, how much do you want for it? Let's say it's $100,000. That means it's 20 payments of $5,000 to add up to that 100,000, but there's really no interest rate, basically. Now, if that's not what they want, they'll bring it up. How do they typically bring it up? Do they say, well, at this, I'm not really earning any interest on my money, or how does that typically come up when it does come up?
It'll come up pre-contract, right? So I'll ask about price, I'll ask about monthly payment, I'll ask about down payment, and usually they'll just butt in, well, how much interest am I getting? And then we got to sort of press the reset button and say, oh, wow, well, you know, gosh, I mean, how much were you hoping for? And most people will say something right around whatever the market rate is
Yeah, very
for a
common.
reason. Like, yeah, exactly. Because that's really all they know. The same way people will be like, well, I want 10% down, or I want 20% down. I want 20% down. Well, they don't actually need 20% down. It's just what the banks
Think,
always do.
yeah,
And so that's what they think is normal. Right. So if they bring up like, hey, well, how much interest am I going to get? And I say, well, what were you hoping to get? They throw out something like 5, 6, 7%. I'm going to say, hey, gosh, I mean, those are like the same terms that I could get at a bank right now. So that doesn't really work for me. I mean, I guess we could make that work. It would just have an impact on price or the down payment. Remember when you said that price was the most important thing to you? I guess, is interest rate now more important than that? And I'm like really exhausting that, everything is a push pull. Everything is a push pull. Well, okay, if I guess we could do that interest rate. You never want to tell them no. Like, we could do that interest rate. We would just need the price down another 50K if we did that. But sellers like that because they like having options. Like, your typical cash buyer is coming to them with a number, and there's a winner and a loser. And that's what's so epic about creative finance is you can totally tweak everything you want to make it a true win-win. And I firmly believe it's the only true win-win in real estate because both sides can get the terms and conditions that they're looking for.
At Offer Now Idaho, we're looking to hire A players to run our organization and help us grow our business. But in what other field can you be talking to people on a regular basis that need help? From losing everything, but that is finally in enough pain where they're ready to change their life. We're out there meeting with these people that need our help. Nobody else is there.
Some of the things that I'm honestly most proud of are the conversations where we had a tangible impact and didn't get the deal. I know that that doesn't add to the bottom line, but it does help in reciprocity and putting goodwill out in the world. I was also an engineer, and I was so many levels removed from having a direct impact on an individual that if you've never had that experience and you're saying, well, I want to be able to look at my family members and said, here's the impact I've had, this is a position will allow you to do that. No matter what seat you're in, you can have a direct impact, and it is such a cool feeling that I didn't appreciate until it happened.
Right now, we have a $3,000 referral program. If you know somebody that's looking for a new role, we will pay you $3,000 once that person is hired by us and they hit their 90-day mark. So if you know of anybody that's looking for a new job or looking to change their life, shoot me a DM at RealRyanWeimer on Instagram.
Let's get it.
Got it. I love it. You know, I don't know if a lot of our viewers recognize this, but even some of the way that you phrase things like, well, that would be the same terms that I can get at a bank. So there really wouldn't be much of an advantage on our end to just do it because a bank would offer me the 20% and the bank would offer me this. So there's like really no advantage. And that kind of like being in a seller's position, it almost makes it like, oh, that's true. You know, like there's no benefit to them if that's the same thing that the bank is asking for it. What are some of the ways to get the down payment lower? I know that you said repairs. That's one of the strategies to use it. Do you ever pitch leaving the money in escrow to use that for repairs on the property? And if not, what are some of the different ways of getting the down payment lower?
Yeah, I would say that's the main way. No, we don't like leave funds in an escrow account and hey, if we don't use this, then it goes to you. We don't even go there. We just say, hey, the property needs some work. And I know that for example, if the property doesn't need any work at all and it's pretty turnkey, a seller is more justified to ask for that higher down payment because their security is you're going to buy it. And then if you put a bad renter in there or you just
They're
completely
going to
wreck
mess it
it,
up. Yeah.
yeah. So you're going to have less leverage when it's not a fixer upper. And that's when it's going to be more tricky to navigate that down payment. And so you're probably going to need a concession elsewhere. Or you can say something like, hey, being truthful is the best policy, right? Hey, I do this to make a profit and I don't even know if we're the right fit here, but you did say the price was the most important thing to you. I mean, gosh, you said you wanted $1 million. What if we did $1,050,000 on the price, but I could get like $30K lower on the down payment? Would that be something you're interested in? Like if I'm getting the other terms, I don't really care about another $50K over the course of 30 years. I care more about my entry fee and knowing what my exit strategy is if I can cash flow day one. So that's for a property that's really fixed up nicely. Like you can come up over even what the seller is asking for as long as you tweak the other terms. And that kind of catches them off guard too, because they're used to being lowballed or low anchored, right? And if you reverse price anchor them, they all of a sudden pay closer attention. They start to lean in like, oh, okay. And now it becomes a conversation. But if you have a fixer upper and something's not rent ready or not recently remodeled, then it's totally going to be, hey, gosh, I got to put like 50K, I got to put 80K into this thing to get it rent ready. I'd have to use some of that down payment towards that to make this make sense.
How much down payment like do you usually try to go for? Like what are some rules of thumb there?
Again, there's so many variables, right? I would say like as our mindset as a team for what we go in is we want to get the down payment at 5% or less, and we're doing 0% interest, and we're doing at least a 30-year note. So that's our mindset going in. Now, the seller can request certain things and take us off of those numbers and we'll still do the deal. But our mindset going in has to be, hey, our baseline is 0% interest and our baseline is 5% down or less. And our baseline, oh, you want 10 years? Gosh, most of the deals we do are at least 30. Because you're just reframing in the seller's mind what they've always been taught and told from 20% down, have to have market interest rate. And you're when you go in and you say, I can do anything to come up to your price, they are significantly more receptive to a really low down payment or these other variables. Also, you leverage your portfolio, right? Hey, I got a title agent here. She does all these creative deals for me. I know this is probably something new to you or you might not have heard about before. Give her a call. And that can be really another closer for you if you have the right title relationship or closing attorney, depending on your state, as leverage. Hey, we do 5 to 8 of these type of creative deals a month with this same gal. Give her a call and she'll go to bat for us and she'll tell you about all the deals that we do and how legit we are, because we don't mess around with this stuff. If we were terrible operators, then we wouldn't be in business. If we got foreclosed on, then we wouldn't be in business. So those are some ways you leverage your portfolio. You always explain to them you're going to use a property manager. There's tricks like that to gain credibility in the seller's eyes and make them feel safer with accepting a lower down payment.
I love it. I love it. Now, let's go to the hybrid model. In the hybrid model, like we talked about, you're taking over somebody's first loan, and then on the second position, you're financing the remaining balance. Do you ever get pushback on them being in second position, and how do you address that?
Yes, we do get pushback, but again, it really all comes down to, is there enough equity in the deal? So should they be concerned? In the worst case scenario, Mr. and Mrs. Seller, if you had to take this property back over again, which has never happened in the history of us doing this, but let's say, I got abducted by aliens, and I literally use that phrase, if I got abducted by aliens, because in their mind, I want them to associate how rare that event is with me getting abducted by aliens. So I say something like that so that they're like, oh yeah, it's just some human psychology. So it's funny how people operate and think. But yeah, so we'll say, hey, if I got abducted by aliens, you had to take this over. I mean, gosh, there's plenty of equity in the home. So what really is the concern here? Are you concerned that you won't get your note balance, or what is your actual concern here? And let's talk about that. And if it's a no equity situation where, hey, we're buying it for the price that they want, and if they had to foreclose, then they might be at risk of not getting their full note balance that's owed to them, then that's part of the risk that they take of us coming up to a really high price that is either at or above market value. And then we're going to say, hey, in order for you guys to actually feel right about this, what I would suggest is maybe we come up a little bit in the down payment, but then we get principal only payments in return. So that way, if you had to foreclose on the property, you get to keep my $50K down payment. That gives you enough room. You get $50K in your pocket right at closing, and then I get the terms on the back end of principal only payments that'll help me cash flow on this thing for the next 20, 30 years.
So I'm gonna play devil's advocate on that. So you're saying that I wouldn't receive any interest on the property? Is that what you're saying if we go principal only?
Well, I'm saying in the event if I get the objection, hey, I'm in second position, it's usually because the seller is scared that if they lose the home, they won't get paid out whatever their note balance is, right?
Mm-hmm.
So their only collateral then is to increase the down payment that they get at closing, right? That's how they get their security is, hey, just increase the down payment and decrease that note size. So for an example, let's say they owe $150K on the property. The property's worth $200, and our purchase price is 200. My down payment is 25K, and so they got another 25K note left. Okay. And if they're like, well, 25K, I mean, gosh, that means you would owe 175 on a property worth 200. And if I had to foreclose and something happened with the market, I wouldn't feel good about that. And so then I would say, well, what if we increase the down payment? So now the note is only going to be, let's say I came up another 5K on the down payment. So now your note is only going to be 20K instead of 25. You walk with an extra 5K in your pocket at closing. Does that make you feel more secure walking with an extra 5K? And I'm going to do these what if scenarios. If they're like, no, that wouldn't do it, then I'm okay. Well, what if we could? And so I'm just turning different knobs, asking them those kind of questions to get down to the real root of the issue. Does that make sense?
Yeah. Got it. Now, what about like if you want to take over somebody's payment and they say, "Well, I'm still on the loan." Like, what happens if you miss a payment? And what happens if you miss, you should just stop paying it, you know? Like, what security do I have that you're going to make the payment?
Sure. So I would say, well, first of all, Mr. and Mrs. Seller, we've done hundreds of these. Here's the title agent we do them through. If that ever happened, then we wouldn't be in business very long, and they can vouch for us that we do this. But second of all, we're going to put a renter in here. So the renter is really going to be paying your payment. It's not going to be us. And these are the property management companies that we use. And then if they have further questions, I just go down that track of like the risk of us not making a payment is so low because we're just going to put a renter in there anyways, and they're going to be the ones paying the mortgage just like any other note.
Got it. Cool, man. Anything else that you think would be helpful? Like, I think we've covered a lot. And what I like about this podcast is that it's a lot of real life type of situations. It's not like, hey, look, like, do it this. You're actually walking through different conversations, and your language pattern is very effective as well, too. Anything else that you think would be helpful for people as it relates to creative finance that you think would be helpful?
Yeah, I think there's a couple quick hitters that I think are really effective. First of all, if you've never done a creative finance deal before, it starts with education. So make sure, like, Pace Morby's got a great YouTube channel on Sub2 and everything creative finance, everything that you need to do your first one, or even to just be educated on a subject so you can make offers to on-market properties or expired listings. Like, all that information is there at your disposal. Realize that this is going to take multiple conversations. It's not going to be as straightforward as a cash deal. So your cash conversion cycle on these deals and your lead to contract number of days on these type of deals is going to be longer, and that's okay. It just takes more. There's more variables for people to think through. And if you've got a team, I see a lot of people making this mistake, and I made it too. If creative finance is new to your team, don't try to throw it on everybody at once and expect them to just all of a sudden pick it up. It's much better to designate one person as your creative finance expert and pour the training into that person and let them handle any type of negotiation. Hey, you got a guy out in the field or at an appointment. Hey, I'm not sure, maybe this situation, maybe I can talk to my creative finance underwriter. Let me pass him to you. You can do a warm or cold transfer or whatever. But just appointing one person instead of your whole team is going to be way more effective than having everyone do it at once.
I love it. You said that you had students earlier today. I don't. If somebody maybe wanted to become a student of yours, where can they find you, and what would that look like as well, too?
Yeah, absolutely. So we do a 6-month and a year-long program. It's all private one-on-one right now. So we're pretty selective about who we bring on. There is a bit of a waiting list, but if you're interested in applying, you can just schedule a call with me at weimerinvestments.com. And then we've got a short application that we'd send you after about things like how many deals have you done? Or if you haven't, what's your current capability? Do you do real estate full-time, part-time? Those type of discovery questions. And then we'll have a 30-minute call with myself to see if we might be a good fit.
I love it. Good. Ryan, I want to say thank you for taking the time to be on the show. This is probably my favorite thing about my day is interviewing people like you. And the reason is I pick up on so many little things. Like this is actually the first time that I had heard don't bring up the interest rate. And I'm like, what's the monthly payment instead? So that was my gold nugget for our viewers. If you got a different gold nugget, make sure to put it in the comments below. So Ryan, thank you once again. For our viewers, thank you for taking the time to watch. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody else, make sure to hit that share button. Thanks again, Ryan. I appreciate it. And to our viewers, until next time.